So in today's lesson, we're going to focus on the nature and behavior of cost. It's a unit, it's unit 1, I think. It's chapter 1 of your module. And we'll be focusing on what costs are, how do they behave, and what is the nature of a cost so that you have a better understanding. And so within this chapter, there's cost objects, classification, and behavior. We're going to look at that. And then there's a unit where you have to estimate, we look at estimation techniques for you to be able to classify your cost. And then there's cost, volume, profit analysis. We're going to look at all these three, and then there might be certain activities that we look at just to make sure that you understand and follow. And as I've mentioned, you feel free to ask any questions inside the group, the chat, the Teams chat. Then I will look at them after, let's say after each unit, each outlined out item here, I would look if you have any questions regarding that, okay? All right, cool. Okay, so the first thing under cost object classification and behavior, it's this diagram. It's inside your module. It talks about assigning cost to cost objects. That's what we're going to look at when you look at your direct and indirect cost. Then we look at how you classify your cost. You classify it according to its nature or origin, where we look at manufacturing and non-manufacturing cost. And then we'll look at the breakdown as to what constitutes a manufacturing cost. Then we'll look at the behavior of the cost. How does it behave? Is it a fixed one or variable, semi-variable, and semi-fixed? We'll look at the definition as to what that means. And please note that as much as it might look like the first class is a bit theory, it's important that you understand the definition of the cost and how they behave, because by the time that we build up with certain topics in this, you should have a clear and proper understanding as to what your cost definition is and how is it defined, so that, defined and how it behaves. It will help you a lot, okay? And then we're also going to look at the relevant range, a specific time frame, and also classification of product or period cost. I tried to summarize this unit, so please bear with me. If I don't touch certain things, please look at the model, the module that you have, and then you can visit the chapters. Cool? So I'd like this session to be interactive as possible. Please raise your hand, and then we can start talking about certain things that I will be asking. Okay, so if I may ask, why do you think we need to have cost for certain objects? Maybe let me do this. Why do you guys feel that it's important, before I show my screen in terms of a presentation, why do you think that it's important for one to cost their objects? Anyone in the room? And please don't give me a textbook answer. Just think about, why do certain objects need to be cost? Like, we have to put a cost to it. Why do you think that it's important to cost something that you produce or something that you provide services for? Thank you. I got an answer to say that to work out the profit. Yes. And also, besides working out the profit, because for you to end up saying that this is what I've made, with costing it, oh, Lisa, you don't have any mics. Please give answers in the chat. Then I will look at them just as I am at the moment. We also, besides profit, we do cost objects so that you can also monitor your costs, right? To see how much are you spending, how much are you willing to spend for whatever quality that you're gonna get, or whatever material that you're gonna get, or even the type of people who are going to work on the product that you have. So we try to, it's for control management of your costs, it's for profit analysis, and sometimes also it helps with knowing how much do you price an object. So when I'm talking about pricing an object, I'm talking about selling price, because for you to end up saying that this is the profit that I'm making, you should have an understanding as to how much did it cost me. And for me to know how it cost me, this is the topic that we're talking about, for you to be able to end up pricing your object in order to make profit. Okay, cool. The other thing is that cost objects can be, as I've mentioned, it's normally products. In management and accounting, they'll specifically be looking at products, but then you can think about a cost object can also be service orientated. It depends as to what is it that you offer to your customers. All right. So always think about what cost is this for. Then you'll be able to know as to how it needs to be allocated or what methods you need to use as we go along, right? So part of the cost that we have, the first one is direct versus indirect costs, okay? So I'm gonna post also inside the group chat, you guys can feel free to answer. What is a direct cost? A direct cost and also an indirect cost. What example can you guys give me of a direct or indirect cost? It is the cost that can be traced to a product, to a physical object. Okay, cool. So yes, a cost object can be, like you're saying, something that you can trace to an object or an activity, something that will lead you to having a finished product, right? So a direct one, it's the one that's traceable directly. Okay, fine. If I'm saying directly, for instance, if I've got a pencil, I'm a pencil manufacturing company. The wood that we use to create that pencil, I'm assuming that pencils are made up of wood, or even the jacket, the sweater that I'm wearing. The material that was used to make my sweater, that would be my direct cost. And then the indirect cost is that if, let's say, you have a table, there's certain nails that you have to do in order to end up with a table. Those are indirect costs. Indirect costs, normally you have to allocate them to the product, because you might find that sometimes the indirect cost is not directly linked to the product that you are manufacturing. So you have to come up with certain methods of allocating that cost. Okay. So if you don't mind, let's go to activity 1.1. It's a simple one where we look at what we just spoke about in terms of direct cost. Okay, so I have it here. This unit 1.1. Let me just go here before we look at the solution. So talking about cost assignment, they say that a manufacturer manufactures wooden furniture. Indicate for each of the following items whether it is a cost object, a direct cost, or an indirect cost, because those are the three main things that we're looking at the moment. So something like A, they say a particular type of desk manufactured. That would be a cost object, because all the activity that goes into the process of making this desk can be, we can cost this particular thing, which is the desk. So it's a cost object. Then B, they talk about the wood that makes the desk. That would be a direct cost, because I can trace, like Senecal said, you can trace it directly to the desk. You can see that this wood goes along with manufacturing the desk. The wages of employees who assemble the desk would be your direct cost also. Because remember, I said direct cost, it's your material, it's also your labor that you can trace to the object. And then a particular type of cupboard manufactured, that would be D. That would be a cost object. Why? Because we can look and see the cupboard that's being manufactured. So I'm not going to finish it all, but maybe let's see E. E says that the nails used to assembling that cupboard, that is an indirect, because you can't, small items hardly, like I was saying, nails, you won't see them when you're looking at a desk. When you're looking at a desk, you will see the wood that's been used, but then the nails are hardly identifiable. You have to literally look for them, so that makes it into a indirect cost. So as I've mentioned, understand, even when you're reading, if you're doing questions, you will have to understand what is the cost object, try to identify what product are we manufacturing, what are the costs that are directly linked to the specific object, because it's going to help you with how you present your income statement. Senegal spoke about making profits, so you would understand how to present your income statement because you'll be able to trace your cost to the specific item that you're producing. You'd also have to understand your indirect cost. What are those, as much as it's small and not easy to identify, they still cost you if you think about it as a business guy or as a management accountant. You should be able to identify what are the other indirect costs that goes into this final product that we are producing. Okay, so we've spoken about assigning costs to a cost object. This is the two parts that we just covered. It's very critical that you understand that. As I've said, it builds up. Then we look at cost classification, right? It's the next one. So with cost classification, we look at total operating cost. What are those? Total operating cost is made up of your manufacturing and your non-manufacturing cost. You ask yourself, what are those manufacturing costs? Those are your factory costs or production costs, the activities that goes into making this product. Those are your production costs, because they are the reason why you ended up having a desk at the end of the day. Those are direct material, we've covered that. Direct labor, we've covered that. There's direct expenses also, and manufacturing overheads that goes into you ending up with, let's say, a car. You need to be able to know what are those production costs, because as I've mentioned, as much as we want to make profit, you need to also know how to monitor and control your costs. Then there's non-manufacturing costs. These are your general out of production. So when you try to think of non-manufacturing costs, these are costs that you incur after your product has been completed. So if I was manufacturing laptops or if I was manufacturing cars, these are the costs that goes over and beyond me making a car, right? So example of that is that once a product is completed, oh, that's great, that's fine. But remember, you need to now start selling, right? You need to start thinking about selling and advertising this thing so that you can recoup the cost that you just incurred, right? So your non-manufacturing costs are your marketing costs, selling and distribution costs. As I've mentioned, you need to make sure that your thing sells so that you recoup your cost. And then administrative costs, those are the ones where you control your organization in order to be operating. So those are your anything general in terms of admin costs. It's the electricity, it's general cost, whereby if you have multiple types of products, this cost applies to all of them. It's not specific to a particular desk. You'll understand as you go along, but I hope you do. That manufacturing, remember, it's your production cost, and then your non-manufacturing are the costs that you incur once your product has been completed. Okay, so I have a diagram here that actually shows, or you could just make sure that you understand the diagram here, because it's a nice summary of saying that what are manufacturing costs? What do I take into account? So with manufacturing costs, these are the three pillars that you need to look at. There's manufacturing overheads, there's direct labor, and then there's direct material. Direct material, easy to identify, we spoke about it. Direct labor, easy to identify because the specific person who's working there should be manufacturing desk. I'm just making an example. So the hours that they spend, it will be linked to making that desk. However, there's manufacturing overheads that goes with this, and manufacturing overheads, it's indirect material. We spoke about the nail, hardly to identify, but it's there and it's very important, it costs you. And then there's indirect labor. Indirect labor, I would say that having an accountant or someone, an accountant in your company would fall under this, because the desk at the end of the day has a factory or a company that that manufactures this. So people who work there for general, just to control the company, like I'm saying, an accountant or someone in finance, that would be your indirect labor, because without them, you wouldn't know if you're making profit or loss, right, on a monthly basis. So you still need to pay them so they can give you that form of report. They would be able to budget for you. They'll be able to say that this is how you allocate your indirect costs. So those people are important in order to maintain a certain standard or control of the company. So those are your indirect labor and other manufacturing costs that we've mentioned, administrative, your marketing, all of those. So they fall, and no, not marketing, sorry, that's not manufacturing, my bad. But other manufacturing costs would fall under manufacturing overheads. All right. So there's also another concept of saying that when you add your manufacturing overheads and your labor, that gives you your conversion cost. Let's think about it. If you have an assembly line where you are creating, let's say, a car, for me to end up having that car, I need people who would work on certain parts of the car in order to convert it into a final product. So that's why it would be manufacturing overheads, which are the things here, and also your direct labor. That is important to have that conversion, taking something which was raw into what we see, right? So, and for that process to happen, somebody has to work on it to convert whatever that you are working with, right? To end up having a finished product. And then prime cost, it's your direct labor and your direct material. So it's important to know these two terms. Why? They will ask you sometimes to say that conversion cost or prime cost. Always remember what defines those two costs. As I've mentioned, please bear with me. It's a bit of theory, but as I've mentioned, it's very important that you take note of what is what makes what. Okay. All right. So we've covered that. We've covered cost classification. The last thing that we're going to look at under outline number 1 is how a cost behaves. Or maybe before we go to how a cost behaves, do you guys have any questions related to what we spoke about in terms of, let me go to the presentation, in terms of what the manufacturing cost is, how do you classify certain costs, before I go to how it behaves? Then the next thing, how does this cost behave? Now we understand what this cost is. How does it behave, right? I think maybe just off topic, it's important as a management accountant to be able to grasp principles, that every single thing has a definition, but you must also, for you to end up manipulating cost or know how to manage them, you need to know how they behave. Even in personal lives, I think that if you take your bank statement, you have to look at what cost normally goes off your bank account. What do you spend your money on, right? That's what I'm saying. That principle that you use in management accounting, you can use them in your life where you're looking now. All right, so every single month there's a certain debit order. Let's say, for instance, I'm hoping that you guys can relate to debit orders. There's a certain debit order that will go off every single month, irrespective of whatever that's happening in my life. This cost is going to go through. I'm going to make an example. For others, it could be your rental amount every single month. I hope you do pay, but a rental amount, it goes off every single month. whether I could be traveling, going to Cape Town, or I could be traveling home in Pretoria or wherever. The fact that I'm in this contractual or lease agreement with my landlord to say that for 12 months, I'd be paying, let's say I'm making an example, 5,000 per month. That is a fixed cost because it remains constant regardless of me changing, meaning I go to Cape Town or I go to Pretoria at the end of the month, I need to pay that amount. Same as a mortgage, it's a fixed term. So even in the production world of producing desk and producing whatever, there's certain costs that remain constant regardless of change in activity. When we say change in activity, we're saying that regardless of this month we produce 5 desks, next month we produce 10, this cost is the same, right? So that's a fixed cost. So I try to make, it's also in your module, it says that these are the total costs, this is the activity. Regardless of what happens in the activity here, this cost stays or remains constant. It's independent from what happens in the activity world, but it's within a relevant range, right? So that's that. That is a fixed cost. Then the other one behaves as a variable cost, right? So with this one, back to the example of the bank statement, I spoke about me paying rent or mortgage every single month. The other one could be a variable cost. A variable cost is the one whereby this month I could be deciding to eat an order from Mr. Delivery. That's variable. Next month I decide actually I want to cook from home instead of going out and having takeouts. That is a variable cost. Unless if you are a very strict person and you say that I'm gonna budget this much, no matter what, this is what I'm budgeting. But in most cases, that's a variable cost. It goes up and down, right? It goes according to the consumption that I make every single month in terms of food, right? Same with the production world. A variable cost, it changes in accordance to activity. How many desks are there? If we're going to produce 10 desks, I need to know how much of wood do I need for one desk. So maybe let's say I need for each desk, I'm making it as simple as possible. For each desk, I need 1 wood. So if I'm gonna make 10, I need 10 wood. If I'm gonna make 5, I need 5, which you guys get me in terms of it is related to the number of units within that activity of producing this final product. So be alert, fixed remains constant regardless of the activity that happens. Variable, it goes along, so it's directly proportional to what happens in the activity. So if the activity increases, it also increases. Okay. Then your cost can behave in another way now, where it's mixed. This one is the case where it is semi-variable or semi-fixed. What is one? The semi-variable one, it's a cost that includes a fixed amount within a relevant range of output and an amount that varies proportionally with the output. So now that's too much wordy word. Let's try to think about an example of the semi-variable. Semi-variable, it could be a situation whereby you have a contract, a phone contract. I think that one is always easy to refer to. So you have a telecom contract. I'm going to make an example. To say that they will tell you that, all right, cool, for this month, for every single month within this contract, we're going to give you first 100 worth of airtime and also 1 gigabyte. However, if you exceed that amount, there's going to be variable cost according to the consumption that you have. So if I have like I was making an example, if for that certain month, I finish my 100 airtime and also my 1 gigabyte, anything that goes beyond that threshold or that range, it now becomes a variable cost because it will depend on how many calls that I make or how much I visit the YouTube or Facebook according to my consumption of data, right? So that's a semi-variable. Then the other one is a semi-fixed. So with the semi-fixed one, the fixed cost increase or decrease only in incremental steps. So it stays constant within the same level, but then it expands. There's an incremental. So I'm going to make an example of a lease, back to a lease agreement. A lease agreement, I'll say that for this year, I need 5,000. Next year, we know any lease, there's an incremental clause there to say that we're going to increase your lease by 10%, for instance. So every single year, there's that step up. Step up, or if you are happy, if you are lucky, you get a decrease. But as you can see, it steps up every single time that clause would be implemented. So before I go to there, let's look at question 3 on page 18 of the. Let's go to question 3. You can also do it at home as an example. So question 3 says that Ntombeni Limited, it's a company. Let me just highlight. Ntombeni Limited is a company that has a financial year end on the 1st of March until the end of Feb. The management accountant of the company has just prepared the budget for the forthcoming year based on the following cost structure. So management accountant, as I've mentioned, costs are important, especially when you are trying to budget for the next year. So they prepared a budget. So let's look at what is it that they have with the cost structure that they have. So the information that they provide you with is that number of units to be produced is 7,000. Okay. Remember, it's for the year. So they're saying they are estimating to produce 7,000 units. Material is 49 Rand per unit. And direct labor is 21 Rand per unit. Okay. Indirect labor, and they also tell you how they are, right? In terms of the nature of that cost. All the indirect labor are variable. It's 28,000. And then other manufacturing costs, hey, look, they say 60% of it is variable, meaning the other 40% is what? It's fixed. So this is other manufacturing in totality. However, you would need to split it into 60 and 40 basis. Then there's the selling and administrative expenses. And then they tell you that, hey, all of these ones are fixed. So I'm going to be blunt. In most cases in your exams, and even in your assignments, you're not going to, most of the time, they wouldn't be telling you what's variable, what's fixed, what's what. Most of the time, so you would have to, they would give you obviously more information as to how the selling and admin costs behave. So you would have to sniff it out from your question papers to understand, is it fixed or is it variable? Anyway, moving along. So within this, they ask you to calculate your prime cost per unit. And we said prime cost is what? Prime cost is your direct labor plus your direct material. That's your prime cost. So they asking you there to calculate what's your prime cost per unit. Then they ask you to also do a conversion cost. So you see, this question is nice because they're forcing you to recall the principles that we just mentioned now. What is the conversion cost? Conversion, remember I said that it's cost that goes with converting certain things in order to form part of the finished product. So that's your labor and also your other manufacturing costs, right? Then total manufacturing cost. Total manufacturing cost, always remember this diagram to say that it's once I've defined my manufacturing overheads, direct labor, and direct material, that will give me my manufacturing cost. What is the period cost? So now they're testing you based on the principles that we taught here to say that period costs are linked to, this was a summary, sorry. Period costs are costs that are not included in the product costs. So those are your indirect costs because these are your non-manufacturing costs. Your non-manufacturing cost. Well, I didn't lose that question. And then they ask you also total variable cost. So for me to answer this total variable cost, and remember they said calculate, so it's straightforward. They don't want you to discuss. But then they say total manufacturing cost. The total manufacturing cost, you know what a manufacturing cost is, direct material, direct labor. So that's one in the back. And then they say, but total manufacturing, remember there's also indirect, there's other manufacturing costs when you're thinking of manufacturing, then you'd have to, the fact that they said that it must be variable, now that means that you need to split here, that 40 and 60, you need to split it. And another thing is that, remember they said total manufacturing cost, your direct labor and your material, they are in a per unit format. So if they are in a per unit format, they ask you for a total cost. So I need a rand value to it. So you would need to say 49 multiplied by 7,021 multiplied by 7,000 in order to get that cost, right? I hope it's clear. So sometimes reading the question is important because they didn't say per unit, they said cost. So they want the total value. Be aware of that. If a company produces, I think with this one, they wanted you to explain something that you can look at when you're at home. I hope that's clear. First session that we looked at, as I've mentioned, it was pretty straightforward, but it's critical as you move on, just to define what your costs are and also be able to know how do they behave. It's very critical because you would be able to make certain decisions when you are a management accountant or if you are a business owner related to to what we spoke about. We can go to another part. So now with this one, we are looking at estimation techniques and the linear equation. So now with estimation techniques, what we're speaking of here is methods to identify semi-variable costs. Remember, we were looking at semi-variable cost as part of how a cost can behave, right? So semi-variable costs, I made an example of a telephone or a phone contract whereby a certain part of it will be fixed within a relevant range, and then thereafter, whatever cost that you incur after that would be variable cost. After I finish my 1 gig, I'm now going to be charged according to the consumption that I make of that data. So what are these tools? The tools that we have is the linear equation. We'll look at it. There's the high-low method, very, very key that you know it. Then there's the scatter diagram and the simple regression analysis. Those are the techniques that are available for you to be able to identify your semi-variable. As I've mentioned, if you look at past papers that you have, most of the time you have to see from the information that, okay, so maybe I need to split. This cost seems like it's a semi-variable, given the information that they gave you. Then you would need to then fall back to your tools. Remember, management accounting is about certain tools that you learn and principles. Then you need to know when to use them. So estimation techniques and linear equation, those are some of the tools that you need to have in your toolbox to say that, okay, now I'm not too sure as to how this cost behaves, then you can fall back to this one. But it has to have characteristics of what a semi-variable is. Okay. I decided to look at two of them, the linear equation and the high-low, because they work well together. And I just want us to look at that. So linear equation, we can even remember it from maths. Those who've done mathematics, you are solving for x. They always say, "Whoa, solve for x." You can solve it via a linear equation. X is normally the unknown, so we try to find out what is this level of activity, or unknown could be, it's in accordance to whatever context that you have from your textbook or from your question paper, right? So I'm not going to define what X is. So I'm just saying X is normally the unknown, or whatever that they would be asking you to determine. Cool. So with linear equation, it's an estimation technique, as I've mentioned, that can be used to project costs at different level of operation. It's a bit mouthful, but it is used so that you can be able to identify your costs. Remember, so what are those costs? The equation, it says that Y is your total cost, which is a dependent variable. So this is your total cost. And remember, total cost, always think it means that it's my direct and my indirect. Then you drill it a bit further. It's my manufacturing and my non-manufacturing. Then you drill it a bit further. You say total cost is my fixed and my variable cost, to make it simple. So A is your total cost, fixed cost. That's A. Then B is your variable cost per unit. And as we've mentioned, variable cost per unit, that would mean that it goes hand in hand. It is dependent on the activity level. So activity level will be X. All right, so that will be your volumes, or the units that you produce, or the machine hours that are being spent on whatever that you're doing, or it could be your inspection hours. As I've mentioned, it's very important that you know X, in what context is X. All right, cool. So that's the linear equation. So when you'll see how it works well with the high-low method, because we use it for high-low method. High-low method, it is it's variable cost per unit. So this would be you solving what? B, right? So for me to find, because remember B, it said it's your variable cost per unit. For me to get that B, the variable cost per unit, I use high-low, all right? With high-low, normally how do I detect or identify high-low? I will see from the question that there's the highest level of activity and there's the lowest level of activity. You might take this for granted to say, yeah, but that's high-low. Sometimes when you have all topics being asked, because remember with the exam, they're going to ask you everything. Sometimes you forget about high-low. That's why I'm saying that always identify it in the question by seeing the highest level and the lowest level. Hey, a light bulb must come in to say, if I am asked to calculate and distinguish my semi-variable into fixed and my variable cost, I must use my tool being the high-low method and linear equation. Cool. So it will be the difference between your costs, because remember, cost per unit, you must have your cost on top, and per means divide, and underneath will be your units. So you have your highest cost that goes with your highest unit, level of activity, then the lowest cost with the lowest activity. Then after the fixed costs are then determined as follows. Remember, fixed cost in your linear equation is your A, right? So high-low is going to help me solve B. I would have my variable cost per unit. Then I would have, I need to get A, remember. So they say that fixed cost, how you do it is that with maths, this one would be the side because I'm trying to solve for A, but then BX, it will be the variable cost per unit and the number of units. So that means that if I bring Y this side, I'll be subtracting. So it will be your total mixed cost, right? Minus your variable cost. You will get your fixed cost. So I've mentioned here activity 2.1 in page 21 as an example. Here it is. Yes. All right, 2.1. It says that Doublet Limited incurred cost as indicated below. Okay. During the 6 months, end of June, these costs changed, but not in the direction to the volume. Okay, interesting. Cool. So what are these costs? They show you the months, January to June, number of units being produced, various, historical cost, various, right? But seeing something like this, as I've mentioned, please don't forget this. In your exam, probably, or in your assignments or wherever, they show you something like this. You need to be able to see they're not just giving me a column of units and cost for nothing. Chances are they might ask a high-low question. So I'm trying to say that try to be cognizant and be alert when you're reading your questions, because you, from reading questions, you are able to think that, oh, if they ask me, meaning they're quiet, if they ask me, chances are a high-low question is going to come. And lo and behold, it comes here to say that use the high-low method to determine the variable cost per unit and the total cost. So let's go here. I'm going to focus on A only. So if you look at the solution, you use high-low, right? High-low, you take the highest level of cost, which is 2060, and also their units. So it's 2060 over 108. Then I have to take my lowest. My lowest cost is 1950, and the units is 95. By doing that, I get my variable cost per unit, which is 10 Rand per unit. And then for me to determine my total fixed cost, I take my 2060, I minus 106 multiplied by the 10 Rand per unit that we spoke about, and then that will be my fixed cost. All right. High-low, straightforward, but hard to identify most of the time because we normally take it for granted in terms of high-low. They will tell me if they want me to use it. Sometimes they don't. So be alert, be aware of why we use high-low. We use it to identify my variable cost of my variable portion of the total cost, right? And also to determine my fixed cost. That's why I use high-low. And for me to get my fixed cost, I need to use linear equation because the equation caters for total cost being fixed and variable. Please be aware of that. Use it as a tool. All right. So before I go to CVP, we spoke about how a cost is being defined. What is a cost object? We spoke about how you classify your cost. We spoke about how cost behaves. We also spoke about this behavior of cost sometimes is not as direct as possible. So what are the tools that I can use to have an understanding how this cost behaves? I spoke about high-low being the one that we use for variable cost. And then also spoke about linear equation, which helps you to identify your fixed cost, right? And then you get it by identify total cost, identifying your variable cost using high-low, and then that's when you be able to get your fixed cost. All right, so that was a mini recap of what is it that we just covered at the moment. So I'm going to focus on the last unit within the chapter that we're focusing on, which is the nature and cost allocation and behavior. No? CVP, what do you guys understand about cost volume of profit? What comes to your mind in terms of why do we use cost volume profit? Why do we do this analysis of doing break even, margin of safety? what comes to your mind? Why would you use this analysis tool if you are either a business person or you are a management accountant? Just the question that I'm posing, that what do you guys understand about CVP, and why would I use, or why would you suggest that somebody uses a CVP analysis? Thank you, Lisa. So she's saying that it's for short-term decision making. True. Why would you advise someone to use CVP? It is to use to investigate any changes in profit and cost. Yes, exactly that. Short-term decision making. Am I supposed to make this order? Is it going to make more profit for me? Am I making any profit from the business that I'm in, or is the business that I'm working for making any profit? What could be the issue? What are the tools that I can use so that I can give them factual answers, right? Cool. So CVP, we're going to look at the assumptions that they have and what contribution is, break-even analysis, and target profit analysis. Okay. CVP is the cost volume profit analysis. It investigates the change in profit as a result of the following. So, meaning, if I'm used to making 100,000 as my profit for the month, if next month I start making 80,000, I need to investigate, why did my profit change? You guys understand? If I am selling sweets, if I'm selling jackets, or if I'm selling sunglasses, whatever that you would be selling, if you are baking or whatever, there's, because you would understand what your costs are, right? And where you stock your stuff, right? You would know that roughly on a monthly basis, I make 5,000 from this business that I'm doing. If that profit changes, you come here to cost volume profit analysis to understand what caused the change in profit. Because remember, profit helps you to budget. If you know your profit, you can then work backwards to say that, okay, what am I spending on? You be able to budget also for yourself to say, with this income, this is what I'm going to use it for. So if it changes, you have to understand, why did it change, right? So some of the reasons why that profit would change is the level of activity. How many products did you produce? How many did you sell, right? The other one is selling price. Did I change my selling price? Did I offer any discounts this month? What could it be that is actually contributing to my change in profit? Variable cost. Did I consume a lot, or did I not consume? Or did I have to buy a lot of material? Did I buy quality that's bad? That's why now I'm buying a lot of material to produce this. And when you're buying more than what you estimated, guess what? Your profit will change. And fixed cost. Did my fixed cost change? You remember that semi-fixed cost, whereby maybe for this year, there's an incremental in the lease clauses that you have. So what could be the reason why my costs change? Variable cost, people are striking. I'm making an example. People could be striking and asking for a raise in their wages, and you do pay for them. Guess what? What's going to affect your bottom line? As much as maybe some of you guys are doing audit, they like saying it's not about the bottom line, but yes, it's not. However, you need to be aware of your bottom line being your profit, because change in that profit means change in other people, is their lifestyle. Other people is being able to pay wages for those people in the next coming month. You get what I mean? So cost volume profit, very key and critical, because it helps you to analyze your bottom line, which is your profit, so that you can have answers, and you can also see a trend if there's any, because you will then, back to Lizelle's point, be able to make certain decisions in the long term. I mean, not in the long term, certain short-term decisions within that period where you have to make a decision that makes sense, right? yeah, so I'm hoping that that makes sense for you as to why do we do cost volume analysis. Very important to know why you use certain tools. Why are you doing what you're doing? Always remember these 4 reasons as to why do we use it. Okay, so there's certain assumptions, right? Assumptions of cost, volume, profit. What are those assumptions of this tool that you're using? When you use this tool of CVP, one of the assumptions that you make is that my selling price is gonna be constant irrespective of the sales volumes. All right. So meaning that if you are selling 150 for your t-shirts, it's just gonna remain as 150 irrespective of how many t-shirts you sell. The other one, it says the costs are linear and can be accurately divided into variable and fixed. So meaning that you can see your cost to be variable and fixed. You don't have to use your high-lows in order for you to identify what type of cost you're dealing with. So with these ones, your costs are clearly defined and accurate to say that this is variable, this is fixed. Then the other assumptions that you use is to say that variable costs are constant per unit, whereas fixed costs are constant within the relevant range. Okay? Meaning your pricing, so what are they saying is that your pricing didn't change and your cost can be identified to say that it's variable or fixed in order for you to use this tool. And then the others, inventory levels don't change. Yeah, so there's a certain, what is crucial is to say that there's a relevant range that you are working towards. So maybe let's say relevant ranges that the normal capacity of my factory to produce certain sweaters is 10,000. So you're working within that range of saying that I am capable of producing 10,000 sweaters. So anything outside that range of 10,000, it means that what? It brings a whole lot of different elements, different costs, different selling price. Everything now becomes different. So for your selling price and for your cost to be constant, meaning no price change because you're operating within a relevant range to say that my max is 10,000. It's between 0 and 10,000. That range results in my selling price being the same, my cost, the cost per unit being the same. So the only thing that could change is the level of activity within this range. The formulas that you need to know by head is contribution. Contribution, how do you define contribution? Contribution is your sales minus your variable cost. That is contribution. It indicates the sales over all variable cost, right? As well as variable selling this one is very key that you are aware that that I can't emphasize that a lot. With contribution, when they say total variable cost, it's total, they didn't say direct it's total, anything that is variable cost as defined. That's what you take into account in your contribution. All right. So hence they're saying as well as variable selling and distribution costs. So when you're reading, once you've identified your variable cost and you're asked to do a CVP analysis, remember that it's all variable cost, all of them. Okay? Irrespective of are they indirect or direct, all variable cost. And then there's a contribution ratio. The ratio is your sales over it's your contribution over your sales. You're trying to get a percentage of your contribution in relation to your sales. The contribution ratio indicates the percentage of sales available to cover your fixed cost, which is very key. So what they're trying to say is that over and above, if I've got a positive contribution, can this contribution cover my fixed cost? right? Because your contribution would have taken into account all your variable costs. What will be remaining will be your fixed costs. So can my sales be able to cover my cost? That's a contribution ratio and what it means. The other one is the break even, right? So we spoke about contribution. Contribution is mostly key when you are trying to see how much money do you actually make, right? After covering your variable cost. And also, excuse me, also to say that can this sales cover my cost, right? So it's more sales orientated. Then you find your break even. Break even is the point where your profit is zero, meaning whatever money that I make, whatever I'm selling, it gets absorbed by your costs, right? So that would be a result where your sales are equal to your costs. As a result, you're not making any profit, which is good sometimes because why am I saying good? Normally, with businesses from when they start, I'd say the first 5 years, they work towards breaking even, right? Because they're still learning, they're still trying to understand their clients, they're still trying to find the cheapest supplier, they're still trying to laborers that be able to produce whatever that you want, highest quality. Are they skillful? Are they not? So those kind of things you learn when you are forming a business, and the first few years in their infant stage, all they are trying to do is just to break even. And then after you've breaking even, that's when you can start now making profit, right? Breaking even is very key. If you do a business, at least try to cover your costs, because operating at a loss sometimes is not good, right? Unless you have a reason, but we can talk about that later. So with break even point, they say when operating performance goes beyond the breaking point, the contribution earned over and above your fixed cost, they represent what? Your profit, right? We just spoke about that. This is the formula. They use linear again, and I told you linear equation, it depends on the context of what you are looking at. And in this instance, remember, example that we're looking at was our total cost. In this instance, Y is your net profit. B is your contribution per unit. And remember, contribution is your sales minus all variable costs, number of units, and then you minus your total fixed cost. That gives you your profit. Okay. The formulas that are key for break-even point, it's your total fixed cost over your contribution per unit. The minimum number of units that has to be sold in order to ensure that you cover your fixed cost. Because it's not nice if you are not able to cover your fixed cost. If you think about your practical life, if you don't cover rent and you don't pay up your car or your home, because your income gets consumed by your variable cost like what you eat or electricity that you pay. If your income can't cover your fixed cost, what happens? You suffer. It's either you get chased out of your home, or your car gets repossessed. I'm just making it a point where you can now try link what you're studying with your real life, because it's easier when you do that. To say that I need to ensure that my income covers my lifestyle. My income covers my fixed cost. So if you can do that, even if you can just be nil before month end, you would know that you've covered everything that constitutes your lifestyle. So even with production, you need to get to a point, as I've mentioned, where your sales can cover all your costs before you can start making profit. Okay? Break even value is just to say that it's the value. Remember, this one, it will be in units, and then this one will be in value. You're just making it into a cost. Like a total amount, not cost, a total amount. So also be alert. Sometimes when you are doing questions, they would ask you to be careful, calculate break even in units. Then you know that you are using this formula. Sometimes they say break even value. If it's value, you use this formula to say break even units multiplied by my selling price per unit, or total cost over contribution ratio, not per unit. Nah? I think it's pretty much straightforward. Then there's a margin of safety. So there's break even, we spoke about it. There's contribution, we spoke about it. Then there's margin of safety. So margin of safety, what is it? Margin of safety, I'll say, they say that it's the total sales minus your break even. So it's the point between how many sales do you need in order to break even? Just your margin of safety in terms of trying to figure that out. So there's margin of safety also in units, margin of safety in in value, and there's a margin of safety in terms of ratio. So margin of safety ratio is the total sales value or units minus break-even sales over your total sales. So that's your margin of safety, just to see how far off are you from making break-even sales. How many sales do I need in order to break even? Okay, so I've covered that. Let's go and do a question. All right, so I just want to do it differently at the moment. I'm gonna project and I want to just see if you guys can answer some of the questions. Drop your answer in the chat so that we can just participate. So I'll give you a minute. We'll look at the question. First question is straightforward. I just want us to do A from A till D, and then we'll look at question 3 together, if that's okay, guys. So question 1. So Boca Limited produces and sells a single product, one product. The following information is obtained from budget for the month end 30 October. All right, so let's see, what do they give us? They give us the value of your sales, which is 1 million. 1 million, that 1 million is made up of 20,000 units, okay? Direct material, which is 200,000 in its value. Then they give you direct labor, it's 150,000. Manufacturing overheads, they break it down for you to say that your variable is 20,000 and your fixed is 80. Then your selling and administrative costs, remember those are your non-manufacturing costs. They come after you have produced whatever product that you are about to sell. Then those costs, they split it also in terms of your variable and your fixed. So a question that I posed to you guys as we just covered contribution break-even, what would be, given this information, the contribution per unit? Please, let's answer A till D. Contribution per unit, contribution ratio, break even in units and in value, and the margin of safety. 5 minutes, so let me just show the question. Remember the formulas that we just looked at should be a bit straightforward. And while you guys are still doing this question, as we go along with the tutorial, we need to work on exam technique, whereby you need to be able to do questions quickly according to the time allocated, so that you don't run out of time. So for you to not run out of time, it's knowing which tools to use when you're approached with a question, and also knowing formulas by head. Because management accounting, it's more like maths. You also need to practice. So for you to know formulas and to know what you're doing, you need to practice almost every day. I've said that before in my classes to say management accounting is like maths, so you must learn to do problem solving. And for you to learn to do problem solving faster, you need to do more questions. When you're done with the section, do the question, time yourself, and you'll see how it will help you to increase your speed of answering, because you'll know formulas by head, you will know what to apply when and how. But then we'll look at those things as we go along when we look at past papers. Seneko, can you please take us through, or Angel or Lisa? I'll start with Seneko. Please, I think let's break it down into, how many are we? 3. So, Seneko, can you tell us the first 2?
Okay, sure. To get the contribution per unit, you work out your contribution. So it is your total sales less all variable costs, which is your direct material, direct labor, your manufacturing overheads, and the selling and admin costs, the variable portion. So then that gets to a 480,000. So then to get to the that is your total contribution. But then per unit, that is then the contribution of 480,000 divided by the 20,000 units sold. That gets you to 20 for every 24 for every product sold or per unit, a 24 rand is then your profit, if I can say, that you can use to cover your fixed cost.
Yeah, it's your contribution that you can
use.
Yes, because when you say profit for other people,
oh sorry,
you're thinking
contribution. Yes.
Yeah, yes.
Okay, so then number B is the contribution ratio. Is then your contribution, the total contribution, the value, the 480,000 divide by the total sales value, which is 1 million, times 100, and then that gets you to the 48%.
Okay, awesome. Thank you so much. Thank you. As she mentioned, can look here. Cool. Selling price mentioned. There it is. Variable cost mentioned. Which ones are there? Then the 480 that she was referring to, and then you divide it by the units, because remember the question was saying per unit. So you divide it by unit, and then you get your 24 Rand. So here they're saying that the exam technique, it saves time to rather work with total amounts, which is the approach that she used, which is correct. You work with the total amount and then thereafter divide, because imagine if you had to do like 1 million over 20. The common denominator is 20,000, so you might as well just get the total value of the contribution, then divide it by the number of units, because at the end of the day, we're trying to get what? The contribution per unit, right? And then she was also correct to say 48%, where you use, it's either you become fancy and you use the unit per unit part, because you've done that 24 Rand, but if you do that, you need the selling price per unit too. Or straightforward, value-wise, you take your 480, you divide it by 1 million, you get 48%. All right, straightforward, right? Not bad, but remember always it's all your variable cost. The next question, Angel, what was your thought process when you're doing your break-even units and value?
So I said total fixed cost divided by the contribution per unit, which is 110,000. The fixed cost, I added the 80,000 plus the 30,000 to get my total, and then I divided that by the 24. And then I got 4,583 and 33 cents.
And your break even, or you said you didn't get to the value?
Yes, I was still busy with that.
Right. So you are correct by saying that the total, it's also total fixed cost, right? It's total fixed cost. So It's both your manufacturing and your non-manufacturing cost. Gives you 110 because you're trying to figure out how much can my sales cover my costs, my fixed cost after taking into account the variable ones. Then it's contribution per unit 24, so it gives you 4.5. You round it up here, and with the value, you know how you should have done value quickly, because that's what I wanted to get to. Value is straightforward. You multiply it by your unit price, your sales unit price, Angel. You see, you could have, I'm just saying if it was an exam. Save time. Break-even value, it's my break-even units multiplied by my sales.
Okay.
Then you get the value. Or if you've got time, it's your fixed cost over your contribution ratio, which was calculated already in B. So either or. So I'm just saying that it wasn't a hectic calc where I'll say it's taking your time that much.
Yeah.
It's about what I've said. Exam technique, learn the formulas. If you learn the formulas and know when to use them, then you know that it's quick, right? But thank you for the attempt. You are correct via break-even units. Thanks. Between Angel and Cynical, how did you guys get to do the margin of safety?
Yes, I got to that.
Let's hear.
Okay, the margin of safety is I got to 77%.
Okay.
Sorry.
You're saying 77%. How did you get there?
Yes, well, I actually worked it out in manually. I didn't write down the formula.
Oh.
But it is 70%, and I can actually tell you that but the interpretation is specifically that your sales can drop with 77% before you start showing a loss or yes.
Yes, yes, you are right.
Yeah. Yes. So, but yeah, the margin of safety is your sales less your break-even sales.
Perfect. Yes. And I like that, to say that, imagine they saying that your sales must decline by 77% before you show a loss. So that's a good fat chance. I'm just saying, like, for it to happen, something dramatic like the looting that just happened should be maybe your cost of loss of sales. Do you guys get it? If I have 77% a margin to say that for it to become loss, that means that I'm doing well, I think. I'm still within a good range to say that something hectic or dramatic has to happen to jeopardize my sales. So I'm still good if you think of it. Not a thing where it's a 50-50 where that's a bit borderline. But 77% is good. So I hope you guys understand now to say that, because we're going to look at question 3 now. I want you guys to also do question 3 to understand what's margin of safety, what's a break even, how do I even get there. Try to work fast, and when I say fast, I'm saying practice. Don't underestimate the questions that we have in here, because it's good practice for you for exam technique. So let's look at question 3. It's the last question for the day. Let's look at question 3. Question 3, it says, Zimbani Limited manufactures and sells a single product. The budgeted monthly information for the next year is as follows. You've got your sales per month, which is 70,000 units on a monthly basis. Selling price per unit, it's 5 Rand. Variable cost per unit, that's 2 Rand. Fixed cost per month, 150,000. Initial investment is 2 million. So they say that calculate the budgeted profit for the year by using cost volume profit principles that you You don't need to compile a statement of comprehensive income. So they want to know what's the profit that we're going to make when you're using the principles of CVP. What profit will we make out of this information that we have? And then they ask you, how many units must be sold per year if the company wishes to earn a net profit of 10% on their initial investment? So if we want to earn 10% of this 2 million, how many units am I supposed to sell annually? Interesting. Then they ask you, what is the break-even point in units and in value? And then I think let's try A, B, and C before we get to D, because D is like proper analysis. Let's do A, B, and C. I'm more interested in B, so if you can, make sure that you do B so that we can have a discussion. Angel, can you please take us through A?
My A, I calculated my sales, and then which I said 70,000 times 5 rand, which gave me an amount of 350,000. I subtracted my variable cost, which is 140,000. I got that by saying 70 times 2 rand. And then I got my contributions, which is 210. And then I subtracted my fixed cost, which is 150,000. And then I got my net profit there of 60,000 per month, which when you need the annual one, you're gonna say 60 times 12 months to get the amount for per annum, which is 720.
Perfect. So straightforward, right? Very straightforward. And then B.
Okay. The initial investment is 2 million, but you want to make 10% of that. So it's times 10%, which gives you 200,000. Then it is from there, you take your fixed cost plus your target profit, divide by your contribution per unit. But the question is asking for the year, not per month.
Yeah.
So the fixed cost of 150,000 times 12 gives you 1.8 million. So it is 1.8 million plus 200,000 divide by your contribution per unit, which is 3 rand. So then that gets to 666,667 rounded up, because you can't make a portion of a unit. So yeah.
Perfect. I like what you mentioned in terms of you can't make half of a unit. So correct, you round it up. The thought process, you firstly, like she said, you identify the net profit. 10% of the initial investment, that's 200,000. And then in terms of number of units, you take your fixed cost plus this net profit that you have, but you need to ensure that it's like for like, right? Like for like means if your net profit is on an annual base, you need to make sure that your fixed cost is also on an annual basis. You can't say plus 150, right? Then you take your net profit plus your fixed cost, because your sales minus that would give you annual cost. It gives you your net profit. So now you're taking it's maths. You take net profit plus fixed cost. It's the equation thing of trying to solve for your units. Then you get your contribution per unit. Then that gives you the number of units that you need to sell for that year in order to achieve this return. Angel, it's your time. Break even units and break even sales value. Did you get to it?
All right, so the formula is fixed cost divided by contribution per unit. So I said our total fixed cost per annum is 1.8 million divided by 3 rand, which I got an amount of 600 units per year. And then obviously per month you will divide that by 12. And then the break-even value, I said 600,000 times the selling price, which is 5 Rand.
Okay.
So,
So yes, fixed cost over contribution per unit. Can we cover our fixed cost? Those are the units that we get, 66,000 per month. And then for value, you multiply it by the sales value. It's also a bit straightforward because, as I'm saying, the more you do it, the more you learn. Thank you guys for the opportunity for the first session. I think it went well from your side. Hence, I'm asking, are there any questions? We covered, I'm saying it went well because we covered the most, and we were able to do questions. At least you can test your theory.